Welcome to the APW Property Podcast. Thanks for joining us. Today I'm joined by Dan Earl from API Global. We're going to be talking all things property, from Dan's journey building a portfolio as an expat to me doing the same, how API help, how we help, some of the key pitfalls, some of the things to look out for, and what DD should go into buying a property. Okay, before we get into it, scan the QR code below to download a copy of our book, 10 Steps to 10K, the Expat Property Playbook. Everything you need to know. So kick it off, big question.
Yeah.
Why UK property?
I'll go back in time a little bit for this, really. I mean, there's a million different reasons why, just the fundamentals of UK property. Look, I looked globally when I actually came in as an investor to even API and the UK property market. And I looked globally at all different sort of property regions, all different asset classes even, right? And it was a situation where if you just look at the fundamentals of what the UK is, it's a tiny island with 80 million people on it, with the fifth largest economy in the world and only so much land. Then you've got crazy stats like, there's a 4.3 million gap in supply and demand imbalances where they're building 100,000 units a year. They're saying they're going to build 300,000.
Nowhere near.
They're never going to do it.
Yeah.
They're never going to do it. So there's going to be another 50 years worth of that gap.
Yeah.
Right? And then you've got the fundamentals around the average age of first-time buyers. It's between 38 to 42.
Yeah, getting later and later, isn't it?
And because of what's actually happening with our friends, the Labour government, is a situation where they're now taxing people, taxing companies more, national insurance. So that goes down from a consumer good perspective. So the price of a beer, the price of everything goes up, and then the capital gains tax goes up. So that's actually crushing that. So if you look at a macro and microeconomic fundamentals of supply and demand and so on and so forth that create growth, the UK outweighs pretty much all of them.
It can be as simple as that, right? Supply and demand. We've got growing population, more and more people moving there, not building enough homes, so prices are going up.
Yeah.
You're saying that you started as a property investor. We've actually got a funny story about that, haven't we? We were supposed to meet you 5 or 6 years ago.
Stu stood me up.
When you were on the client side to talk about property. But Stu, if you're watching.
Wherever you are.
Stu stood you up. But I think it's quite interesting. So you were an investor and now you're working in property, helping other investors do what you've done or, replicate your part, I guess.
Yeah, exactly. And so, I was in tech for like 17 years, did reasonably well out of it.
You're not that old, are you?
No, I'm looking at it now. And so I was looking for really this is a mixture of sort of wealth preservation, because property just by nature is a better asset class from a safety perspective. And, you have the governments and banks are the reasons why property is so stable is because they're both incentivized to keep it that way. So I like that element to it, and then I was looking at, how I can create passive income and make my money work harder, right? And so when we're looking at leverage structures and things like that, made a lot of sense. Made a lot of sense, and obviously found API, clearly the best in the market at what they did. Bought a number of properties with them over the last 5 years and liked it so much that I ended up joining them. And now we're partners.
Good segue into API, I guess. So you started on the buyer side as an investor. Now you're working for API. You are one of our partners. So for anyone listening, what is it exactly that API does? How do you help people? I know there's a lot of overlap between what we do, but you're sort of more on the developer side, I guess, and bringing opportunities to market, whereas we're more pure client facing, I guess. So what's the difference and what do API do?
So I mean, look, API, just first of all, from the history of it, started by Mike Layton about 11 years ago. He comes from a commercial real estate sector, companies like CBRE, some of the largest ones in the world. And it's taking, what API do is you take a regulated mindset to an unregulated asset class. So commercial real estate is a regulated asset class, residential isn't. So the first start of the API stands for Assured Property Investments. What we're doing is mitigating risk initially, and we're really looking at this and how we package product for partners and investors to essentially look at this as a family business, and whether that's wealth preservation, retirement planning, succession planning, all these different things wrapped up to build high performing property portfolios for people and the very best investment grade opportunities. So the way that we even source projects is we're looking at macroeconomic growth areas funded. Really what we're looking at is education, corporate relocation and transport. So when we've got, let's take Manchester as an example. If you've got macroeconomic growth of the whole region all the way out to the not so nice areas further out. And what we do is we go micro, right? And we're looking at the Zone 1 Manchester, right next to train stations, right next to, really close to connectivity to get into CBDs, all these different things. So you're land grabbing that, but also best product. And we're looking at construction teams for sustainable actual growth of these and quality of build.
Yeah.
And even when we look at demographics like, there's more 25 to 29-year-olds in the region than anywhere else.
Manchester.
In Manchester.
Yeah.
And that's just an example. But some of the products that we bring to market, Vivere is a great example of this. One of the reasons that we bought that branded residence, which is right next to that station, and with all the facilities that's on board, is
Cornbrook.
Yeah, right next to Cornbrook Station.
Yeah.
It's one stop away from the new $2 billion redevelopment of Man United Stadium. We're 3 minutes into Dean's.
Is that happening? Is that real? Because I saw an article pop up and I was like,
yeah.
So it's signed off, or it's just early
No, that's
stages?
happening. That's happening. This is going to be, going to be the best stadium in the world, right? I mean, and it's a whole redevelopment, that area, retail, everything. And so, another $2 billion going into Manchester as a city, which, you've already got Bank of New York, Amazon, BBC, ITV, Sky. Google, exactly.
There you go.
So from there you get to Google in probably 5 minutes door to door.
Yeah, okay.
But more to my point around this is, because the demographic of even the age range in Manchester, where you've got 25 to 29-year-olds in the whole city, they don't want to live in a 2 up, 2 down thing from the 70s.
No.
They want to live there with co-working spaces, gyms, so on and so forth. So we're even very particular with what we bring to market to be a sustainable long-term investment grade product.
Yeah.
And then once we've signed off on that, and then we've found the best of the best in terms of a actual product, then we've got 121 point due diligence sign-off assessment.
Blimey.
Which exactly it's needed in this asset class, trust me. There's some absolute.
What does that, can you give us? I mean, I knew you had a thorough DD process, but I didn't realize it was 121 points.
And that comes from that regulated mindset to the unregulated asset class. So it starts off with things like liquidity of developer, JCT contracts being signed. We're 9 times out of 10 we're getting 100% deposit protection. So for W Residences, which was one of our really successful launches last year, even if Manchester was bombed during build, you'd get your money back.
Yeah.
It's better deposit protection than the bank. And so empowering, companies like yourself to be able to sell this investment grade products, which far stands out against anything else in the market. We are the global leader in terms of
deposit protection, just by the way, is that some sort of insurance? Is that an insurance policy, or how does it work?
It depends on the terms that we do it. Sometimes for that one, it's actually Fred Doan's the owner of Salboy. This was Gary Neville, actually, which is another partner of ours, which is Relentless Development. So he bought the land when he was at Man United. Took about 12 years just to get in the planning permission, because this is cobble streets right next to the town hall and things.
Yeah.
So even from that perspective, then it was a co-development between Salboy. James Bowler Brindley was the architects, and then Marriott Bonvoy, and obviously W Residences. So even when we talk about how we were looking at bringing that to market, Fred Doan, who's the owner of Salboy, he's also the owner of Betfred, which is a giant bookies in the UK, worth over $2 billion, I think. So it's a Fred Doan guarantee. So, 100% deposit protection.
Yeah.
Where can you get that, right? And so the biggest issue with off-plan builds, as an example, is usually the build risk.
Yeah. So
us as a business, we mitigate that, right? From a quality perspective, from a go-to-market perspective, all of it. But API is a slightly different business to other ones in the market. We really see ourselves as financial advisory, but just using real estate as the financial instrument here. Yeah. So it's about structuring, and whether you're looking at, it's about optimizing it and making sure that you are aligning to your investment goals, essentially.
Yeah, I think you understand what people are trying to achieve with property. It's not just the feature, it's a good property in a good location. It's the feature and then the benefit. This is wealth creation for the long term. It's a education pot for your kids, it's a retirement pot, whatever it might be. So I think you guys sit quite nicely in the middle. So the things you look for in terms of what makes a good buy-to-let: core location in a city centre, good employers, good population growth, good build. Anything else you would add to that makes a good buy and a good buying location? Yeah,
well, I mean, look, I think it all needs to align really to what the overall investor goals are. Right, because that's really what we're doing this for. I mean, I talk a lot about return on capital invested, right? Because really the way you want to look at this is, okay, I've got 100 grand, I've got 10 million, I've got 500 grand, or whatever that is, and then I want to have I don't know, 10 grand a month passive income for when I retire in 10 years. And how do we get there to make that happen?
Have you read our book?
I've read bits.
In
I've
10
read
steps.
bits. Yeah, yeah.
10 steps to 10K a month.
Yeah, yeah. Do you want to, are we going to put that up?
Are we going to, you can hold it up. There you go.
Yeah. So the Callum Williamson Expert Property Playbook. I will read it. I promise I will read it.
So you're on the other side of the fence now, but what you said about goals I think is important. That's why I mention it, because it's 10 steps, but the first 5 steps in that are, it's your goals and your planning. Because if you have a crystal clear end goal, then as you were just saying, it becomes so easy to work back from that and actually say, okay, I want X amount of income by X date, and I've got these resources, cash and time to get there. Therefore, these are the assets and locations that work, right?
Yeah.
And so it's so much easier if you have people come to us and say, I want to invest in property. Yeah. Well, what do you want to achieve? I don't know. Right, we'll go away, have a think about it, or we can help you think about it. Yeah. And then it becomes much easier, right? So I think the goals thing is an important thing.
100%, and that's where you need to work back from there, basically.
Okay. This one, we were just talking about goals. I appreciate this will probably depend on what your goals are. Yeah. What do you think is the best property strategy? Is it buy and hold for the long term? Is it, people do the BRRR, the buy, refurbish, refinance, rent out? Is it, there's so many different strategies. Yeah. I personally like just buy and hold for the long term, simple, vanilla, buy to let, city centre locations, 1 or 2 bed flats. What do you think is the best strategy for people just trying to build wealth?
Well, I can tell you my exact strategy, right? So what I do, and I invest in API's products, right? I bought another 3 last year. Yeah. Waterhouse Gardens is going live this year. I'm having a nightmare. You cannot get around the frustrations around putting a mortgage in. It is what it is, guys. But it's a nightmare, but it's a short-term pain for long-term gain.
Yeah, if it was easy, everyone would do it, right? So.
Correct. My strategy is, so first of all, let's go back a step. And the reason why I think property as an asset class is the best one is because you get to play with a leveraged asset, right? So just for leverage, I mean, you get to play with a mortgage, right? So if you put in 25% into a property and your leveraged asset grows by 1%, you make a 4% return on capital invested. Yeah. There's very few, stock market can't do it, and very few asset classes where you can actually do this, and particularly in this level of safety. So that's really what drew me in to property and why that is my family business now. That's, hopefully it'll be a combination of wealth preservation, retirement planning, and succession planning, because even the fact that we can put shareholders in as the kids and be exempt from inheritance tax and things like that. But the bigger thing around it is I like to buy where investors make the most money in a project is the first 20% of a project sale, right? So the very first 20% is the cheapest that you're ever going to get this at, right?
Just so people know, that's in an off plan.
On an off plan development, right? So my strategy is I always go as far off plan as possible.
Same.
Buy at the cheapest possible price point, because that price point is when the developers are de-risking the project. So if we buy in at that price point, all the way through that, let alone the macro growth and all the regional growth, and if there's interest rate dips, everyone buys, and all of these other great things that happen during a natural life cycle of property. If we're talking about buying at the cheapest price point, it's like buying the dip really in a stock side of things, right? Yeah. Which everyone's at the moment, dip. When's the dip ending? But the key thing here is you're buying at the actual cheapest possible price point that you can ever buy at.
Yeah.
Right. And then you ride that growth. And also you're not even getting mortgages or things like that. So, I mean, some of them you either put in 20% in or 25%. If you've got macro growth of a region, like, to be honest, anywhere that API would advise you to invest in, so Birmingham, Manchester, regeneration zones in London, so on and so forth. If you've got 20% growth of the whole region and you only stay at the same trajectory over a 2-year build phase of that, and you've only put 25% into the property, that 10% growth during those 2 years, you're making a 40% return on capital invested in 2 years, annualized 20%. And that's really what my strategy is. Once that goes live, about a year later, I've usually made a reasonable amount on top of that. I'll release equity again by refinancing it, and then I'll buy another one. So, I'm in a situation where I've got sort of 9 live at the moment, another 3 going live over the next sort of 2 years or 3 years. My portfolio is now sort of self-funding itself.
Yeah.
Right. And then the goal is for the next 5 years we scale it, and so I keep doing that. Yeah. And then for the next 5 years after that, all I'm doing is paying that off. So then all
mortgages.
Exactly. Yeah. And then we pump that in, and then the passive income grows. And that's if you're talking about retirement planning,
Yeah.
right? That, it's mailbox money, and really.
But I think that's the hardest thing to do, though, is, and something we talk about in the book, is the hardest thing is actually getting the first one or two under your belt, because that's where you need to buy it with savings and your own cash. When you start
bonuses and things like that. Yeah.
When you start getting to 3 or 4 or 4 or 5 years into your portfolio, then you can start pulling cash out, buying more, and as you say, it becomes self-funding, and then you decide. Do I take the income to buy more?
Yeah.
Do I take the income to pay down? Do I take the income as pocket money?
Correct. And look, so a lot of people think that having a property paid off is the best thing ever. I do portfolio reviews with people all the time where they've got like £1 million in their property in, I don't know, London or somewhere like this, and they're making like a 4% yield. Right? Yeah. That's the most money you have in the world, and you're making 4% on it.
It's locked
As
up
someone
in
who's financial advisory is what we really do. It's all about return on capital invested and making your money work as hard as possible. Yeah. So I've got an example of one of my clients the other day. I took them from a 4%, so it was actually about 850 grand that they had in there, and they were getting a 4% yield on it. What I did in this review, first of all, I realised that they were getting paid, I think it was 1,500 a month less than what they should have been paid on their current place.
Yeah.
Then we've refinanced it, pulled out 300k of that, bought 3 properties in a much better structure from a tax perspective. So we put them in a special purpose vehicle. Yeah. And then I worked out sort of where we were at after that. I went from 4% to 24%, so 20% better return on capital invested.
Yeah.
And that's really what you need to do.
I think a lot of people are, debt's always been peddled as a bad thing, isn't it? There's, debt is bad. But I think when it's good debt, like a mortgage, you should be using it as much as possible.
And also, just on that, inflation. Like, people don't understand what inflation is.
It's your friend.
Well, it is your friend, because and that's why I do interest-only mortgages as well. And
Same.
so I'm going to be pulling it off because the value of your debt and money is decreasing while you're making money on top of it. So you put the least in to make the maximum amount.
I was chatting to Stu about it the other day. I think the first place he bought was in Hackney 35 years ago.
Yeah.
And I think it had a 50 grand mortgage on it. That 50 grand now is worth nowhere near what the 50 grand was then. So you could easily pay that off now versus back then. So I think you should use it. It's
a great example of it.
Yeah, it was very good.
And so debt is your friend. I mean, look at Elon Musk and things like that, right? He's buying massive businesses through debt and leveraging through stocks and things like that, and he shares. Like any super rich people that you would look at and how they view debt, it's free money, right? It's free money, and the whole value of it there is you're compounding at a 4-to-1 ratio is what I always advise clients to try and do. So if we put in 20, I mean, the Vivere one that I was talking about, you only actually have to put 20% down over the build phase. So you're at a 5-to-1 ratio during build before you even got a mortgage.
20% in one go on exchange of contracts, or have you broken that up?
It's 10 and 10. So 10 on exchange, which would be about 40 grand on a 400k property, and then another 40 about 6 months later.
Which I think
that's it.
I think
until Q2 2027.
Yeah, I think if you don't know an awful lot about property, or you don't work in it, off-plan is often seen as, it's got negative connotations. But I think that's how I buy mine. I think it's great because it's so good from a cash flow perspective.
Correct.
Rather than needing to stick 70 grand deposit plus your stamp duty plus legals, whatever in one go, 80,000 quid, you can drip feed it in, so you can buy more of these things over a 2-3 year period, right? Rather than all in one go. And you're not competing with the open market either. You can look at floor plans and say, okay, I like the look of this unit, let's reserve it with a little bit down. You don't need to battle in viewings with other people and then get into a bidding war. So I think it's as long as you work with reputable developers that have got a track record that build a good product, right?
100%. And that's once again, if I do bring it back to the API perspective, that we are the best investment grade product in the world at what we do, right? That's why we're signed off by FTSE 100 businesses. We're the only ones that can get through the due diligence. Private banking sector, that's where most of my clients sit, right? We're investment grade product, right? We're not, we don't go to subpar areas. We wouldn't have, even just to get signed off by API, right? We look at hundreds and hundreds and hundreds of developments, right? It's real sort of siloing of a lot of crap, to be honest, right? But you still make money from it, a load of the other stuff, because of the state of the actual just general market and look at 200 years worth of data on UK property. It does what it says on the tin.
Yeah.
But if you actually do it in the proper sort of structures, if you are buying the growth zones within the growth zones, you will massively outperform that. I think our average is like 16.2% during a build phase.
Yeah.
In our last like 5 developments, I use that case study all the time. But if you're doing that and you're only putting 25% in, you're doing 60% growth during just build over a 2-year period.
Yeah, and I think as well, you say, you know, buying the growth in the growth zones. I think a lot of people, especially when they're new to property, stress about buying in the perfect location.
Yeah.
I think if you just strip it back, as long as you buy in somewhere that is got the fundamentals we spoke about earlier, you know, then it's going to do well. Obviously, the more key central it is, the better, but you're still going to do well if your time frame is 10, 15, 20 years.
Yeah.
Here's one for you.
Yeah.
Best and worst buys. Have you ever had a bad property experience? Because I feel like if you do enough of them, you'll get one eventually.
Look, I think that I haven't personally, and this is only because...
Could you work with API?
No, it's not because look, I'm the son of a developer. So my dad was a developer, and so worked on building sites and things like that as a kid. But I wouldn't buy crap.
Yeah,
and that's the big differentiator here. I think if you buy crap, you're going to get crap. It's just like football boots or anything like that. You buy twice.
Yeah, that's the saying, isn't it? Buy well, buy once. You know, and you buy quality. Yeah, it'll last forever, or at least for a long time. And I think we did a post or an article on it the other day. Is pay peanuts, what'd you get?
Monkeys.
And people are like, well, I've seen this place in the northeast. It's 11% yield. I can buy 3 of them with 100 grand. So okay, that's good. The yield is good, but have you factored in the fact that it's going to be empty for 3 months because you're changing tenants because it's getting trashed?
Can you get a mortgage on it because you're overpaying for it and they're just giving you back the same money?
Yeah, so buy well, buy quality, maybe pay a bit more is my view. Yeah, but you buy it once and it's good stuff.
And also land grab. Look, I mean, I talk about Birmingham and Manchester a lot at the moment, but I think there's a reason for that. Literally, buy B1 Birmingham, buy M1 Manchester, buy the most central postcodes because all that's going to happen is zone 2, zone 3, zone 4. Right? Let's land grab the best areas in the best locations where the biggest growth is. It's not we're not reinventing the wheel here, right? It's if you stick to simple things with properties and fundamentals around quality, right? Proper due diligence, deposit protection, a structure which aligns to your overall growth strategy and your personal family strategy, and get it in the right tax structures particularly.
Which you would say, by the way, is it's just an SPV now, isn't it? Are there any other?
Well, look, first time buyer, you get the first time buyer release. So I would say the first one you stick in your own name, but then after that, 100% you want to stick it in a special purpose vehicle. So for any viewers that don't know what that is, it's say Callum and I were buying a property together. It would be Callum and Dan Limited, and the business that we set up would own the property. And then there's loads of different wins from that, but you pay corporate tax, you don't pay capital gains tax, so you don't pay personal tax. You can write off all these different business expenses, massive one being
mortgage interest.
Interest, but lots of other things along anything, furniture packs, so on and so forth, because it's a business expense. And remember, you only pay tax on profit.
Yeah.
So, particularly as you're scaling, if you're doing what I'm doing at the moment, where I'm using the money to buy more, right? It's not a profitable business, right? I think my across 9, I made about 30 grand last year.
Yeah,
right? And so I paid 19% of that.
Early days, you're not earning much.
And then even when the strategy for me is, say you're making 300 or 400 grand a year coming out the back of it in passive income, you can still pay. If I'm somewhere like I live in Singapore, I can pay myself in tax-free dividends out of that, right? And I'll be subject to it'll be 25% tax because I'll be at the higher band rate.
Yeah.
But that's all I'll be subject to.
But also anything that when you give money to the company, you lend it to the company, right? So anything you lend in terms of your deposits, etc., over the years can be taken as a return of director's loan, tax-free, or something I didn't know you could do, found out the other day, is you can charge yourself interest on your director's loan. So if you've got, over time, 250 grand's worth of director's loan, you can say, right, I'm going to charge myself. It's got to be a reasonable amount of interest. So at the moment, you could say 7%, and you can pay yourself interest tax-free. So there's heaps of. And I was reading an article, I think it was 2 weeks ago, and they were saying the biggest sector now in the UK for companies being set up and current companies is
there's more. There's
UK.
more. Yeah, more property companies than any other company.
Fast food chains, everything is the biggest.
Which actually that's by design for the government as well. So
yeah, for sure, because it's transparent, isn't it?
Yeah, 100%. Which is good as well, because it also sort of, they're not gonna, if you what you want to do while you're building your portfolio is keep it to a small business, because they're not going to start changing legislation on small businesses, right? You sort of offset any government brain farts, which obviously we're seeing a lot of at the moment. Hopefully in the next 4 years, when Labour are out again, I think you'll see a much more free trade approach to the UK, which I'm certainly hoping for, because I believe that the growth of it needs to come from entrepreneurs building businesses, and that's definitely, if you look at Singapore, Dubai, all these other places which are thriving, free trade is the way to go forward, and that's how you bring people money in. But that's a different conversation.
So talking about personal experience again, I guess, couple of questions. I think it gets easier the more you do it, right? The most daunting buy you'll make is the very first buy, because everything's brand new. You've never done a mortgage. You don't know where to buy. You don't know how to buy. You don't know what conveyancing means. You don't know what legals is, stamp duty is. It's all daunting. And then it gets easier when you buy. But what would you say, what sort of advice would you give to someone that is just starting out? Maybe there's an expat out there listening to this. We had a guy in Saudi last week write in and say, I listened to your podcast, very interesting. So maybe there's someone in Saudi that's thinking, okay, this all sounds great. I'd like to do what Dan's doing, but where do I start? Obviously you read the book, but if you don't have access to the book, what do you do?
Well, first reach out to professionals, right? And who know what they're doing. That's the first thing to do. It's very funny actually. One of my best clients, who now's got a portfolio of she's got 15 properties that she wanted to scale quickly, but she started off thinking, I'm going to go off and do this on my own, and realised there's a minefield of just crap out there. First of all, all these different people saying different things. You need proper financial advisory for this real estate as an asset class, right? It's all about the structures, what your end goal is, and what you're trying to do this for, whether that's wealth preservation, succession planning, retirement planning, so on and so forth. And the biggest fundamental is don't buy crap. Right? All these nightmare stories that you hear about, issues with lower socioeconomic areas, or bad build quality and things like that. I mean, even one of the things that we get from a new build perspective, even at API, is we get 10-year build warranty. Right? Things like that is just, it's essential to make sure that they're in there. And if it's an off-plan build, things have run an absolute mile away. One of my mates, he's from Liverpool, but we won't hold that against him. Exactly. But there's this absolute rogue developer coming out saying, all right, they wanted 35% deposit and no deposit protection. I mean, so that's if it gets built, we'll build it. But if not, we're going to take your money, because we're using your money to build the development.
And that's it. It's the DD, isn't it? Is it investor-led or developer-led? I.e., do the investor's deposits pay for it, or is the developer paying for it and then recouping it off you? But I think you're right, working with professionals. I mean, I'm lucky, you're lucky. We do it for a living, so it's actually easy to do our own stuff on the side. But if I was teaching full-time and I had young kids, or if I was a banking professional at the top of my game in wherever, or even not at the top of my game, banking, any other profession outside of property, and you've got kids, you've got hobbies, it would be impossible to get the time to do it unless you're really driven and motivated. You're like, right, I'm going to do 3 hours research Saturday morning, I'm going to do 2 on Sunday, and then I'm going to set these milestones. It's difficult to do, I think, when you have life happening around you, So I think working with professionals, or just speaking to people at least who have done it before, if they're professionals and not Bob from the pub.
Well, there's a lot of Bob from the pubs. There's a lot of Bob from the pubs. It's hilarious. I'm in some groups with things, and every just the amount of different things come up, and we're getting, we've been told this, we've seen this. I mean, there's some absolute jokes, some of the stories within the industry around some charlatans, let's say, of businesses who are trying to get into and work with people who are giving terrible advice. I think that you also make sure you're working with the right people who actually know what they're doing, who really, if they're not asking you questions around what the goals are of this investment are, what the structure from a tax perspective that is, from a, how you're funding this, because
how do you know what is the right fit if you don't ask the right questions? You need to have someone's full picture to be able to say, based on your situation and what you're trying to achieve, this might be a good fit.
Yeah, exactly. And look at historical data and performance of these businesses or these developers. I mean, most of the developers that we work with, it really is a situation where, we're on like our 16th development with. They're tier 1 developers. The construction teams, we're even signing off on construction teams now because of the build quality, and it's getting down to that level of detail, which we do and sort of package and take to market with people. So super important.
Well, what advice would you give to someone starting? What gets easier as you get more experienced or grow, and what gets more difficult in terms of portfolio and managing it? So what becomes easier and what becomes more difficult?
Well, the cash flow comes easier, right? Because you're making more money, right? And so the cash flow comes easier, and then you also know what's working and aligning to what you're trying to achieve better. And look, some people don't do it with one organization. Some people like to kiss a few frogs first. So they think they're not doing that again, right? So I think it gets easier because your understanding gets bigger. And then usually what happens is people have a really good experience, certainly with us, and they end up loading up. And then they're very surprised with the speed that they're able to start loading up, and then the scale of their portfolio. I mean, I did a mapping for a client the other day at about 750 grand pounds, buying about £3 million pounds worth of property. 10 properties. I'm rounding numbers here, but 10 properties. Then you're in a situation where you've got probably £2,000 a month per property, so you're at 240 grand a year you're making. Off that, obviously you've got 20 grand a month coming in. Then you've got all these tax deductibles. Where you're only on paper probably making about 35 grand a year, which that's all you're paying tax on. Then you've got £3 million sort of pounds worth of asset where you've only put 750,000 into it. Then if you did a mean average of what the UK's growth is, you'd be making £1 million on top of that 3 million at that stage of probably about 7 years. We would do that faster at API, but it's a situation where then you've got that 1 million here, which is capital gains. So you've got a couple of different options that you can do there. First of all, anyone that knows what they're doing with property doesn't sell it, because then you have to pay capital gains tax. Refinance. And if you're doing at the stage where I'm at, I'm trying to use that million and I'll buy another 10 because I'm scaling. Now, if I was 5 years off retirement and it's a situation where I want to stop paying that off and getting more passive income, now I put that 1 million into the 3 million.
You just review it, don't you? And
you've got 1.75 now paid off, and you only owe 1.25. So your 240 grand that you had previously coming in, now that's probably in anyone's money going to be, after 7 years, 300,000 coming in.
Can I just say, this is a lot of numbers.
I know, and I can put some dates up there that we can put on the background, a visual of
Jamie,
that.
can we put something on the screen?
Yeah, Jamie, can you
Hey Jamie, can you pull that up?
The key thing that I'm saying there is you'll have about 1.25 million, which will be still owed, right? And so you'll have passive income on top of that, say 200 grand coming in. But once, for the next 5 years, out from your retirement, you pay that debt off.
You take that to pay the debt down.
And then you've probably at 350,000 after 10 years. Coming in passive income from 750,000 invested. Right.
Understood.
And that's really the retirement. That's when you talk about retirement planning. That's really how you do it. You look at that.
Yeah, right? I think you've got to, with property, you've got to take a long-term view. Correct. I think 5 years as a bare minimum. But the longer you can do it, the better. And I think actually, even if you're retiring at 50 and you're 45 now, it's not 5 years you've got to build to. You're going to live for another 50 years maybe, 40. So it's actually the next 45 years you've still got to build to. So I think sometimes people get caught up with when they want to retire versus how long they're actually going to be living off the portfolio for. So
and look, when we talk about as well, the great thing about property is everyone needs somewhere to live. So if you buy in the best areas, it's just it's not like the cash ends. Some people have a deluded view of, okay, if I've got £10 million, that'll be enough, right? Where realistically, you want something that's actually bringing passive income, which is continuous income. And that's, in my opinion, the reason why most of my money in the world goes into property.
Do you do stocks and shares or anything like that?
I do indexes. I do S&P 500 Vanguard.
I've just started that. Started
at the
8
dip,
weeks
hopefully.
ago.
Oh man, what are you doing?
So it's down a lot, to be fair. So, but that's,
you have to take a long-term view on that.
Not
as well.
stressed at all.
Exactly.
Again, it's a 10, 15 year thing.
Yeah.
But,
but the difference between that as well, and this is what I always say to people, is that's obviously do that as well, because it's all about a diversified portfolio for people's families' wealth anyway. But the fact that you don't get, the fact that in property you get to play with a leverage asset, and you can do that from a UK perspective, particularly in sort of, you know, certain regions where you're averaging a 6% plus yield.
yeah.
Right, because that obviously services the debt. If you can do a 4-to-1 ratio, so your stock market, when it goes up 1%, you make 1%.
Yeah.
Right. If
When
we
you
can
say
do
4-to-1 ratio, you mean 25% deposit, 75% mortgage.
yeah, but even before that even goes live. So if you're only putting 20% in before it goes live as well, it's a situation where you never put another penny down.
Yeah.
And if that grows by 10%, you've made a 50% return on capital invested before it even goes live.
Yeah.
And that, I mean, some people flip, right, and do that because they made 50% in 2 years. They just take the money out and go. And that's a strategy. There's loads of different ways to do it. Wouldn't be the one that I would do, because I'd take a longer term view on it. But I think the fact that you can play with the leveraged asset is just massive.
Okay. Would you buy overseas outside of the UK?
Yeah. We've got a place in Australia, which is, well, it's a nightmare because it's a situation where it's never been really cash flow positive, so you have to put money into it.
It's a different strategy in Australia though, isn't it? Because most people negative gear down there because it's very difficult, especially where is it, Sydney? Or
Sydney,
so difficult in Sydney
negative
to get
gearing.
anything that's cash flow positive. Like even 1-bed flats, won't be positive. But it's very much capital appreciation play over there, isn't it? And that's how they make their money. It's appreciate, refinance, go again.
But that's why if you look at UK against Australia, I think UK is way better, because even just if you look at, and I talk about return on capital invested because we want to take the emotion out of it, and we're looking at 100 grand and how you can maximize that from an ROI or whatever it is. You have to put too much of your capital into it to make it cash flow positive.
Yeah,
you're
100%.
constantly having to drip into it. You don't want to do that. When I'm investing in these ones off plan, I'm never putting another penny into it.
Yeah.
Right, and that's the whole strategy. It's just making me. That's another good point. In property, you make capital appreciation and yield, so you have 2 revenue streams working for you all the time, right? And so my strategy is I want to put in as little as possible to make it cash flow positive, and then let that run and make me money.
Yeah,
right?
and then the equity and the capital pot grow. Okay, so we've talked a lot about the positives of property there, right? And people watching and listening are probably thinking, well, of course you'd say all that positive stuff because you work in property. Let's try and maybe be a bit more real with it. What would you say are some of the negatives or the hard points about property, other than the fact that it is just very hard to do and it's quite complicated if you don't understand it? But what would you say are some of the negatives, if you can think of any?
Look, like I said before, I think it all comes down to who you're working with and what you're buying, right? From a pitfall perspective, particularly in this region, we're obviously in Asia Pacific. We've got all these like absolute charlatans selling crap, right? And that's, if you have bad build quality, you're gonna have issues, right? If you've got, businesses, coming out with, anytime anyone hears guaranteed yields, run a mile, right? Because there's a reason, and they're getting it from somewhere that overinflating
inflated price, and then they give it back to you, or
100%. And so these are the things that the massive pitfalls. If I was going to say the first thing that you need to look out for, guaranteed yields, run, right? And then other things needs to be the detail that people are going into around the construction teams, the JCT contracts, all these things that
security, whether you've got long stop dates, you've got step over insurance, funds are in escrow, investor led, developer led, if you've got all of those things in place.
100%. I mean, look, for an API perspective, I mean, like, so my property's live. I don't know the names of any of my tenants, don't want to, right? I don't know, never in a situation where I've ever been called about a boiler breaking or anything like that. It was actually quite embarrassing. So Pippa from Redstone messaged me the other day because one of my places in Birmingham is up for renewal and they want to renew. I was like, how much is the rent that we're getting? I don't even know how much rent we're getting. And then where is it in comparison to the market? And that's the most intervention I've had. So also, I would strongly advise, if you're an expat, don't do it yourself. Don't mess around with that. Right? Let someone else deal with 100%, that, who are a professional organisation. Get on with your life.
Even my managing agents know I'm an expat, and I've said, don't contact me, because I don't want to hear about it. Even they called me the other day, and they're like, the tenant sent me a picture of the thing that holds the toilet paper, and a screw had come loose, and it was just hanging down a bit. And they said the tenant is wondering if you can call someone out to put a screw in. So it's 50 quid call out plus the parts, whatever. And I said, no. So they asked me, I said, first of all, don't
Tell
ask
them
me
to
about
put the
this
screw
sort
in
of stuff.
themselves.
And second of all, tell him to put the screw in himself.
Yeah.
I guess it's one of those things. But yeah, you should definitely work with a managing agent, you know, because it's money well spent.
An investor-led managing agent as well. So also from an ROI perspective on that. So one of my places in Birmingham, again, has a parking spot. New tenants came in, they didn't want the parking spot. Redstone even relet the parking spot for 150 quid a month.
Yeah, nice.
And it's about, I can't stress enough, it's about return on capital invested and seeing this as a family financial, you know, family business really is the way. So we're talking about this obviously from the lens of how API are and how I see property, because it's not about going and buying your dream home or anything like that.
Yeah.
These are completely different arguments around it. And then it's all about what you like and making sure the build quality is there, but it's a emotional play. We're all about taking the emotion out of it and looking at it as how much money can we make.
It's head versus heart, isn't it? You know, your heart is a place you'd want to live.
Yeah.
And your head is just do the figures,
Yeah.
stack up. Does it make sense? Is it going to make me money?
Correct.
You know, and that's what you need to do it on, I think, head
Yeah.
versus heart. And a lot of people get caught up in, oh, well, that's nice because I'd like to live there. It doesn't matter. It's about where the 25 to 35-year-old white-collar professionals want to live and work, you know, and that's city centres, new build places. But if that's the type of tenant you're going for, you know, if you're trying to target young families or whatever, then it's a different kind of tenant, obviously different kind of property, different kind of location. But, you know, the money is...
You follow the money, right? And it's all about hedging risk, right? In my opinion, once again, one of the big pitfalls that people make, you know, don't go and buy miles away where there's less, you know, I'd go back to Manchester just because it's been the best growth in the UK for the last few years. I mean, like, you know, even from a student university perspective, you know, there's 6 universities, 120,000 students, one of the largest in the whole of Europe, with a 51.5% stay rate. It's self-populating just with students, right? And higher educated students. So strategic businesses...
Stay rate being the amount of students that study there then stay.
After uni and staying there.
Yeah.
And so even corporates are leaving places like London and using Manchester now, where they want to suck up all that young talent, don't want to pay 50 million for a massive tower in Canary Wharf or whatever. They're in a situation where they can pay less to get the same talent. So even fiscally and from a P&L perspective, it's better.
Yeah, for sure.
Let alone they've already got the young talent there.
Yeah.
Right, and the living costs, so on and so forth. There's a big macro shift which has happened in the UK since COVID, which people need to take advantage of. I mean, I've been land grabbing central Birmingham and Manchester massively. That is my strategy, right? Because if you HS2 lines, you got pretty much all of retail banking now is in flipping Birmingham and Cornwall Road.
Yeah.
You know, you've got BBC is a massive site in Manchester, Media City, so on and so forth. Bank of New York, the biggest and oldest bank in America, they've got a massive office which they've just launched in Manchester.
Yeah, and these
going live.
These are the things you need to look at, I think. You know,
it's 86 billion economy in its own and growing. 5,000 new people moving to the city centre in Manchester a year. I know these stats because they're on one of the fact sheets I was looking at earlier.
All right, Dan. Well, thanks very much for coming in.
Thank you, buddy.
It's been. I think it's always interesting when you have a conversation with someone that has been through the buying process as an expat, because I feel like you get a lot more insight from that versus come and watch our webinar. You know, people have listened to what you've got to say, what I've got to say, whether they take that as valuable or not. I think it's insightful. So thanks for coming in.
Turned us off after 2 minutes, didn't they?
And we'll see you again soon, I hope.
Yeah, no, perfect. Thanks for having me. And look, I think the key thing that, if there is a last note to let people know, that, you know, reach out, speak to us about this type of thing. You know, I can do completely free, you know, portfolio reviews. It's a situation where we can sit down and really map whatever your family's goals are or personal goals are.
Bro, that's it. Have a chat with a professional. Thanks, Dan. We'll see you soon.
Cheers, mate. Bye-bye.
If you enjoyed that conversation and found it useful and you'd like to figure out how you can start building your own portfolio, then get your hands on a copy of our book, 10 Steps to 10K a Month in UK Property. It's 10 crystal clear steps showing you how you can do it yourself. So grab a copy, have a read, and if you'd like to reach out and have a chat with us, then please do so.